how much can you write off?
Last year I was able to get my taxes to zero. This year I thought I bought enough real estate to get my taxes to zero. So if you're a W-2 taxpayer and you go into real estate, you'll come to find out that the deductions from real estate don't offset your W-2 income unless you're utilizing specific tax laws.
Today we're talking to Karlton Dennis. He's a tax strategist who helped over 10,000 clients legally save on their taxes. I will ask him for all the tips and strategies when it comes to tax reduction.
We work with a lot of entrepreneurs that are celebrities, ball players, rappers. They come to us all the time. Can we write off this jewelry? Can we write off these watches? Can we have our children working with us inside of our business, even if they're doing janitorial services, or maybe my child is working as my social media manager? So the IRS was looking into my YouTube videos and they actually called me out right when I started my YouTube channel.
Did someone report, or how did they find your channel?
Someone did report, and then the IRS looked at my videos. They realized, no, the information this guy is sharing is correct. He's just needing to call himself a tax professional, not a tax accountant. And that's the truth. I'm not an accountant, but I am working in the capacity as a professional where I'm studying law, interpreting law, and then helping people formulate strategies to reduce their taxes. Believe it or not, there was only less than 500,000 audits in the United States last year in 2022. Less than 500,000.
But it's going to be more because they hired 80,000
They did.
people.
Yes.
But of course, as always, when it comes to implementation, please consult with your tax professional. This video is not intended as tax advice. It's just for you to suggest strategies to your CPA and see if they can be applied to your particular case.
Hey guys, welcome to Silicon Valley Girl. I have the best tax professional here, Karlton. Like, so many tips, so many life hacks. But let's start with how the IRS looks at this.
Yeah.
Because you got a call from them, right?
I did get a call from the IRS.
What did they say?
So the IRS was looking into my YouTube videos and they actually called me out right when I started my YouTube channel because I was calling myself a tax accountant and I'm really a tax professional.
So they actually checked?
They checked everything. They asked me to send over my degree, what like publications that I've read on, and they also asked for my license and my ID. And they just wanted to verify that I was truly a licensed professional, but I couldn't be on YouTube telling everybody that I was a tax accountant when really I'm a tax professional. Mm-hmm. There's a true difference in that.
Did they fine you for that, or they're like?
They didn't fine me for it, but they made me take that YouTube video down. And every other YouTube video, they started auditing for that year. And that was in 2020. So anytime I had a YouTube video, they would have me send over a copy of the YouTube video before I posted it.
Seriously?
And this was just to verify that I wasn't giving falsified information.
Did someone report, or how did they find your channel?
Someone did report. So someone had actually reported to the IRS that I was sharing tax information that wasn't legitimate. And then the IRS looked at my videos. They realized, no, the information this guy is sharing is correct. He's just needing to call himself a tax professional, not a tax accountant. And that's the truth. I'm not an accountant. I'm not sitting behind a computer filing tax returns all day, but I am working in the capacity as a professional where I'm studying law, interpreting law, and then helping people formulate strategies to reduce their taxes.
Got it. And now, so how often do you get on the call with the IRS?
Okay, so I don't talk to the IRS like that anymore. And to be completely honest, a lot of IRS auditors actually turned around and started studying my videos, and they used some of my content to help them with IRS audit cases.
Oh, that's
so
amazing.
Now I guess the IRS loves my videos and they're supporting me.
Have they ever audited you? Or?
No, they have not audited any of my companies or really me or my wife in the past 6 years. So.
Have you like talked to other creators? What is the chance of being audited if you're a creator?
Well, it's all around how much income that you're making, and most taxpayers who are earning less than $300,000 a year are going to be audited less than 0.019%.
300K gross, right?
Yeah, 300K gross. And then once you cross over $1 million a year, that's when it goes up to around 1%. And then right when you cross over 8 figures, meaning you're earning over 10 million, your audit risk jumps all the way to 3% a year.
Oh, that's not too bad though.
Not too bad.
Yeah.
But believe it or not, there was only less than 500,000 audits in the United States last year in 2022. Less than 500,000.
But it's going to be more because they hired 80,000
They did.
people.
Yes. But those 80,000 people also need to get trained first. So the IRS has a lot of training to do and a lot of catch up to do with everything that went on in 2020 with the inflation adjusted tax brackets and COVID and all the policies that came out during that time.
Yeah, so we expect more audits in 2024. What do you think?
I think we will be seeing more audits in 2024, especially in an election year. I think so.
Oh, yeah.
Yeah.
I want to quickly pause here and thank Novo, who is kindly sponsoring this video. Novo is an award-winning banking solution that empowers small businesses to unlock their potential. Spend less time and energy energy managing your finances and more time on what really matters with Novo's free online checking account and suite of automated business tools. Keep work and personal finances separate with Novo's physical and virtual debit cards. Plus, automate your budgeting for up to 10 categories, ensuring you're always prepared for taxes, rainy days, or inventory needs. Novo's business checking accounts are free from sneaky fees, monthly fees, or minimum balance requirements, and provide free money movement via ACH, mail checks, and incoming wires with express availability. And enjoy unlimited one-time or recurring professional invoices, free of charge. Streamline your operations, boost your productivity, and drive growth with Novo's seamless integrations to the top business tools you use, bringing all of your finances into one simple view. To learn more about Novo's features and benefits, check the link in the description under this video. And now let's get back to our video.
All right, let's talk about the tax strategies, because some of the strategies you talk about on your channel, I just wanted to highlight for people, like make a video that has all of them. So the first thing that I wanted to discuss, the 100-day rule when you are renting out short term.
Yeah, absolutely.
Can you talk about that?
So yeah, the IRS has specific rules around real estate investors being able to turn around and use losses from real estate to offset active forms of income. So if you're a W-2 taxpayer and you go into real estate, you'll come to find out that the deductions from real estate don't offset your W-2 income, unless you're utilizing specific tax laws. And this specific tax law, called Section 469, allows for real estate investors who are running a short-term rental, on average 7 days or less per customer, to turn around and utilize real estate losses to offset their W-2, their 1099, their LLC, or their S-corporation income. But they need to materially participate. And material participation in the IRS tax code is 7 different tests. But of those 7 tests, the easiest one, and the one that most taxpayers will abide by, is the 100 hours and more than any other person.
Do you need to be licensed?
Nope, you don't need to be licensed. You don't need to be a realtor. You just have to show the IRS that you spent 100 hours managing your rental property in the year, and that each of your customers that are in that property are staying on that property for an average of 7 days or less per stay.
Oh, an average. Okay, because I was thinking, do you need to put this threshold in Airbnb, like you can't book for more than 7 days? So you can't, it's just the average, right?
That's correct, the average between all customers in the year.
Got it. So how much can you write off?
So when you're doing a cost segregation study, which is the tax strategy used on rental real estate, you're accelerating the building's value. And typically you're getting anywhere between 20 to 30% of that building's value written off in the first year.
If you put that into numbers, so for example, a condo is 1.2 million.
Yeah.
How much of that would be the build? Like, how is it even calculated?
Yeah, so let's just say that you bought a condo that's $1 million. Half of that condo might be the building's value, half of that condo might be the land's value.
Who determines that?
What's determined is when the property was built, the city will do an assessment to determine how much of the land is worth and how much of the building is worth when the project goes up. And the building amount is what you get to depreciate on your tax returns.
Up to 30% even, or?
And you can take up to 30% of the building's value when you perform a cost segregation study.
In the first year, or?
In the first year.
What happens in the second and in the third?
So since you're only accelerating 30% of the building's value, you have about 70% that's left over.
Yeah.
That 70% is still going to be written off, but it's written off over the course of 27 and a half years. So although you might have accelerated 30%, you still have this other 70% that's going to come to you incremental over the course of 27 and a half years.
So the ideal strategy then is to buy a property every year.
And I teach that, yeah.
And this is what you do?
Absolutely. Me and my wife have purchased real estate every single year since learning about this strategy, and we created a community where we help everyday taxpayers buy real estate to offset their W-2 and 1099 taxes. And many of these real estate investors are getting to a place where they're offsetting a majority of their W-2 income, which in turn gives them enough money for the following years.
The down payment.
Down payment, exactly.
Wow, that's, how many properties do you have?
Me personally, I have 6 properties now.
So 6 years ago you found out about this,
Yeah,
right?
6 years ago I was just getting into syndication real estate, so I partnered with other investors to buy a multifamily unit, but I didn't really have control over the decisions or how to improve that property, but it did teach me about real estate. So when I learned about depreciation and real estate professional status and the short-term rental rule, I made it a goal of mine to buy my first short-term with my wife. And since then we've acquired Yeah, about 6 properties all on our own outside of the properties that we invested in a syndication with other investors.
That's amazing. Which states?
We're in Florida and we're in Texas. The properties that we have in Florida are in Deerfield Beach and Boca Raton, and the properties that we have in Texas are in a city called Lubbock. In Lubbock, we have all of our multifamily deals there, and we own 3 duplexes there right now.
And Florida would be the short-term rentals, right?
Yeah, and Florida's the
economics
short-term rentals.
Work?
And the economics work. Yes, we got into short-term rentals in Florida right in 2020. So it was right when everyone was moving to Florida, everyone was leaving high tax states like California to be in a place that was more affordable during COVID. Well, this was also when Airbnb was starting to really pick up and many people were looking for a place to stay outside of their apartment. So we listed those properties that we purchased on Airbnb and performed cost segregation studies, and we made sure our tenants were staying in those properties less than 7 days.
Amazing. And do you think it still makes sense in 2024?
I do, but it requires a different strategy. Many people who were going into Airbnb were just going into Airbnb because the money was good and everyone was traveling. Well, now less people are traveling because of inflation and the cost of living. So it takes a different type of manager to be successful at Airbnb in 2024 than someone who may have jumped into Airbnb in 2022. How you list your property, the amenities you might have for your property, the furniture, the photos that you choose to take, and the location of your property matter so much more heading into 2024 as they did in 2022 when everyone was just trying to stay in an Airbnb and get out of the house.
Yeah, so you do that. Is that what your company helps with?
Yes, absolutely. Our company helps with locating the property, running the cost segregation study numbers, putting together your LLC, and making sure you get all your write-offs in time for filing your returns.
Do you charge like a fixed price for that, or you take a percentage? How does that work?
Yeah, so we have fixed prices for people who are doing tax planning with us, and those who are trying to do cost segregation studies, that's on a gradient depending on the building's value. Because if you have a really big property, it's going to take more engineers to perform a cost segregation study. If you have a smaller property, it might only be a photographer that needs to go to the property to take photos of the inside and out for the tax professional to put together the study.
If you go to Florida, 2024, what's the minimum down payment?
2024 minimum down payment on a Florida property. If you're going to buy it as an investment property, you're probably looking at somewhere around $100,000 to $150,000, and that's because the median home price in Florida has jumped probably to about $550,000, almost $600,000. So if you're putting a 20% down payment down, you're coming in with at least 6 figures.
It still sounds reasonable.
Yeah.
So you can start this, whatever we talked about, you can start it with 150K.
Yeah, absolutely. And that's what I recommend for many people who are trying to get out of the rat race is first get to $50,000 saved in like your own savings account. Then go put 50K into the market. So that way you have money that's earning more than 0.001%. But then your next bucket is let's get to that 100K so that way you can start buying investment properties, especially short-term rentals that could offset your W-2 income so you can get to retirement faster.
Are any of these write-offs?
This is not a write-off, I will say, and these are technically write-offs, but I chose not to write them off because I'm not really using them for business. Like if I was leaving to go into work or, driving to the coffee shop, I could have this as like a transportation vehicle and write off the cost of this, but because I have so many other things I'm already deducting, it's not worth me even claiming these expenses. And then with luxury vehicles, the IRS has a luxury vehicle limit of only $14,100, so this doesn't really save me money in taxes by writing it off.
$14,000, that's the limit you can write off?
For a luxury vehicle in the first year, yeah.
Okay, let's talk about another tax strategy.
Yeah.
Let's talk about vehicles.
Okay.
Let's talk about luxury vehicles and let's talk about like in general, like what kind of vehicle can you write off? How does the write-off work?
Yeah, so when it comes to vehicles, you can buy a car that weighs over 6,000 pounds or a car that weighs under 6,000 pounds and have a completely different tax deduction. For many entrepreneurs, you'll see them buying vehicles that weigh over 6,000 pounds because self-employed business owners are trying to reduce their tax bill, and the IRS created a law called Code Section 179 to support business owners in buying equipment and vehicles and allowing them to write them off all in 1 year.
Okay, question.
Yes.
So creators understood this rule in a way that they started buying G-Wagons,
yes,
Cadillacs, etc. But as I understand it, the IRS wanted, construction workers to buy trucks, right?
Yeah.
Because initially that was the thing. Did the IRS understand that creators are using it not in the way it was supposed to?
I don't think that the IRS was going to think that what happened actually ended up happening, but the reason why it happened is because the power of the internet. During 2020, when we were all stuck at home, all suffering from COVID, we saw a shift in information, and people having more access to tax information led them to taking more risks or led them to taking more purchases as a business owner. So we saw tons of entrepreneurs rushing to Mercedes dealership, or even entrepreneurs buying Rolls-Royce Cullinans, because they found out that just like how these big entrepreneurs are taking all these deductions, I can take these deductions as well now that I have access to the right information. So if you buy a vehicle that weighs over 6,000 pounds, you can write off 100% of the purchase price. In 2023, it's at 80% bonus depreciation.
Regardless of the brand, regardless of...
Not necessarily regardless of the brand. And when I say that, it's because the IRS created this rule called the luxury vehicle deduction.
After 2020?
After 2017.
Okay.
And if you are riding in what they deem as a luxury vehicle, and they have a list of cars that they deem as luxury vehicles, there is a luxury vehicle limit on those cars. And typically they're only allowing you to write anywhere between about $14,000 to $16,000 a year as a write-off. So you're kind of capped, whereas someone who's buying something that's not as luxurious, that is over 6,000 pounds, they can write off the entire purchase price in 1 year, such as like a Cadillac Escalade or a Yukon Denali.
Cadillac, do you think it's not a luxury vehicle? So the IRS didn't put it on the list?
They did not put the Cadillac on the list.
Wow,
no.
That's interesting, right? Like, where is this? Or
why is this line there?
Yeah,
and how do I get around it?
Interesting. But with the, even if it's a luxury vehicle and you write off 14K, you said there is a California law that allows you, if you're in California, you can write off like 100% of it. And
so there are certain states that haven't abided to Donald Trump's Tax Cuts and Jobs Act, or at least not all of the laws that he created. And California is one of those states that said, hey, we get all these other people are allowing you to deduct on the federal side and the state side vehicles that weigh over 6,000 pounds. But here in the state of California, we're not going to allow that. So you can do that on the federal return with the IRS, but on your state return, all of the depreciation that you took is going to be added back to your income in order for you to file your tax return at the state side in California. So for example, if I made $200,000 and I'm self-employed and bought a vehicle that weighed over 6,000 pounds and maybe the purchase price was 100 grand. If I'm writing off $100,000 on my tax returns, it's going to reduce my adjusted gross income down to 100K. It's just a smooth $100,000 write-off. Well, on the California side, it's going to look as if I have $200,000 of income because in the state of California, they don't acknowledge bonus depreciation. So that money gets added back onto your income and it's subject to California state taxes, which is as high as 13.3%.
Wow. Okay, so careful with that.
Yeah, it's just something to know.
Yeah, interesting. Okay, let's talk about other write-offs that are not that obvious. So there's 401k, right? Also, another question before we jump into that. When you start a side business, when can expenses become tax deductions? Is it when you have your first income or?
So the cool thing about when you start a side hustle is the IRS defines that you can start taking business deductions as soon as your business is considered active. Now, you could not make any money between now and the end of the year, but you are running an active business, meaning you have a home office, you've spent money on supplies, equipment, even training. All of these expenses to get your business off the ground are considered startup costs, and the IRS allows for you to write that off on your tax returns. They do have a limit in how much you can deduct against ordinary income in the year, which is typically about $5,000, but all of the expenses in excess of $5,000 is still a tax deduction to the business owner, just over a course of time.
What's the maximum amount of years that the IRS is willing to wait for you to start actually getting income?
So that's good that you asked that question.
Hobby versus business.
Hobby versus business is a huge topic with the IRS, and many business owners get caught running hobby businesses because their business never makes any money. They never have an economic gain. So the IRS has this rule that if your business has not made income after 2 years, or you haven't shown an economic gain after 2 years, on the third year, your business could be audited and they could disallow your business from being a true business, and it could be ruled a hobby. And that means the years in which you claim those expenses going back to the very first year, all of those expenses get disallowed, which means you have to refile your tax returns and you'll pay penalties and late fees for what you should have paid on the tax.
Okay, so it doesn't have to be profitable year 3, but it has to start making some kind of revenue, right?
That is 100% correct. Maybe I was in a place in my first year where I had no income and maybe 5,000 or 10,000 expenses. And then the next year I made 20,000, but I had 40,000 expenses. And then the third year I made my first 6 figures, but then I was at a loss because we spent $101,000. Well, I'm making an economic gain every single year. I'm just not profitable yet. And that to the IRS is a sign that you're trying to grow your business. But if you're just claiming losses on the tax return and there's no income, it could seem like you're trying to get around the IRS and the taxes that you're supposed to pay to them. So this is when the IRS will rule your business a hobby business, or they'll audit you to determine if you're running a hobby.
Let's talk about contractors outside the US. I know a lot of people have started utilizing that. And it looks like magic because you only pay your contractors abroad. You don't owe any taxes in the US because they're not US people. Is there anything to look out for?
Not a whole lot to look out for, as contractors outside of the United States don't have to file a US-based tax return because they're not located in the United States. But from a documentation perspective, you still need to provide these contractors a W-9. If these contractors don't have a social security number, then you need to request an I-10 number and still issue them a W-9. So that way, legally, you're able to write them off. And if you are audited, it shows that you are able to claim them as a contractor.
What if it's just a W-8-EN?
Yes, W-8-EIN.
If they don't have the ITN, right? They
That's
just
correct.
sign that form.
Then they sign that form.
And that's it.
That's it. It's just for documentation purposes. Your business holds on to that. And in the event that the IRS auditor ever decides to question your expenses, being that you have contractor expenses, they will know that you took the right process to identify who your contractor is and how much you paid that contractor in that particular year.
Do you ask for invoices from the contractor? Like, what's the right way to document that? Because a lot of people are like, they're outsourcing editing to India. Like, how do you work around that documentation-wise?
It's a matter of making sure that you're requesting this documentation before they start working for you. Because sometimes we're so eager to jump into entrepreneurship and hiring people and trying to grow our business, and then we find out later about all the things that we're supposed to be doing tax-wise. So on the onset, I would recommend consulting with a tax professional to make sure you have the proper documentation to provide to your contractors, and that you get that documentation back, so that way you're protecting yourself as a business owner. Because the IRS isn't going to require you to submit any information to them on a yearly basis for non-US based contractors. They do require you just hold on to that documentation. But if you never got that documentation, that contractor is gone in the wind, and you get audited for that particular year, they could disallow your expenses, including your contractor fees, because you didn't take the right steps to get your documentation in order.
Apart from that form, what else could that be? Invoices every month from the contract? Like, I mean, okay, my contractor costs $10K, they're outside the US, the IRS comes in, asks, what was that for? I'm like, okay, they were editing videos. How do you keep track of that? I don't know, they have a Google spreadsheet. Is that enough, or they need something more? I don't know.
Job description and the invoices, the payments actually coming out of the business's bank account. That shows that the IRS that you're claiming a business expense, and the job description shows that you hired this person on a specific date to do a specific duty. And that's important for the IRS, because the IRS cares about whether or not you're treating the contractor like a true contractor, or if you're treating them more like an employee and you're dictating their time, their schedule, and their ability to work for you.
Okay, so we talked about real estate, we talked about vehicles, we talked about independent contractors outside the US.
Yeah.
2 more tricks. Give me something else that's overlooked by a lot of creators, small business owners.
Yeah, I mean, the vehicle one is just a hot topic just because there's so many creators that are out and about creating content, so they want to have a nice vehicle, and they find out that they can buy a vehicle over 6,000 pounds. So I would say that's the sexy write-off. The one that's not so sexy is, well, don't we have children? Don't we have little kiddos?
Let's talk about kids.
Little kiddos
Let's monetize
at home?
our kids.
Can we have our children working with us inside of our business, even if they're doing janitorial services, or maybe my child is working as my social media manager? And this is when we can turn around and place children on payroll. Because the standard deduction is the amount that you have to jump past to in order to file a tax return. If you have a child that's underneath the age of 18 who works for you, you can pay them up to the standard deduction, which is around $13,850 for 2023, without the child needing to file a tax return. And in return, mom or dad could receive a $13,000 deduction on their tax returns for claiming their children. If you want to take it a step further, which many business owners do, they'll open up a custodial Roth IRA for their children, and then the money that they paid their child, that money will then funnel into a Roth IRA at $6,000 a year, and now they have tax-free money growing for their children with the same money that they got a tax deduction from.
That's awesome. Cool. And this is the living room, right? I feel like this would be my spot for filming.
Has to be.
Yeah, because it's just, all the light and all of the different locations that you can have here.
From 12 o'clock, you get the sunlight on this side, and then 4 o'clock, you get the sunlight on that side. This is the screen where I'll write down stuff or watch music videos, stay motivated throughout the day. Yeah, mainly here just jotting down ideas, though. I'm already doing talking about LLCs and S corporations.
Does it look good on the video?
Oh yeah.
Yeah, you use it?
Yeah. Mm-hmm. Yeah.
Wow.
Especially for shorts too, where I like want to teach simple money concepts.
Nice.
Like, hey, here's this principle that I created. But there are 3 buckets that you need to have your income in. Yeah.
That's
and it
great.
shows up pretty good on video.
I need one.
I actually had one of my videos go to almost 2 million, and it was the first time I used the board. I was like, damn, I should probably be using the board more often.
Yeah, people love that.
Yeah, you can take Zoom calls on this. You can do just about anything on this. Internet, Zoom, YouTube, Netflix, Peloton.
I'm ordering this. How much is it?
It's $5,000. It's a good year in tax write-off. Yeah.
Okay, and number 5.
Oof.
Let's talk about production wardrobe.
Okay.
This is a huge question for me.
Yeah.
I know you can buy things to wear in a video, for example.
Yes.
But where is the fine line? Like, what if you get a Rolex and say it's a write-off because I review watches, or I just want to look, I'm a rapper, I need this bling bling, whatever.
Yeah.
How does the IRS look at that?
So it's very interesting because the IRS wants to make sure that the expense is ordinary to your business, necessary in nature to your business, and reasonable in nature to your business. So we work with a lot of entrepreneurs that are celebrities, ball players, rappers, and they come to us all the time. Can we write off this jewelry? Can we write off these watches? And for the type of entrepreneur that is carrying a brand image that revolves around luxury and can show the IRS that these items are actually turning around and helping them make more money, then these entrepreneurs, ball players, celebrities are actually able to write off their luxury underneath their business. I have had so many, and this is not a lot of entertainers, but I've had so many women in the entertainment space do something similar. Instead of with luxury watches, they want to, transform their body, make cosmetic, changes with their body.
But it's double use because you use it in your real life.
And the IRS actually tried to fight a woman on this back
that was the case.
Back in 2012, and she won
Okay.
in tax court because she was able to show that her breast augmentation led to her making more money and was a direct contributor to her brand. For many entrepreneurs, they're not able to show that wearing a luxury watch is making a significant difference with their brand, or is drawing in revenue with their brand, or that this is a part of their uniform and what they wear every single day. But for some celebrities, they are able to show that. They are able to show how having this luxury watch and this luxury car and wearing it every single day and having it on their album cover and in their music videos contributes to them making more money because it's a part of their equipment and that they're using for marketing. And that's when it becomes tax deductible.
Wouldn't the IRS say, but why won't you buy just a good copy of like fake watch or like fake diamonds and just work? Because I guess this is what happens in the movie industry, right? They don't buy all the Pateks or whatever they're wearing.
Yeah. They'll rent it, right, in the movies.
Yeah, exactly. Why
Absolutely.
would the IRS tell that to a creator who's trying to write off a...
So there's 2 ways that the IRS can play this. One is understanding that the business owner might be in a position where they can afford to pay for these type of expenses, and thus can show that it's reasonable for the business owner in the pursuit of income to be able to pay for that first class seat instead of that economy seat, or to pay for a luxury watch instead of a basic watch that you can get off the shelf at Target, right?
Yeah.
So there is the reasonable clause, and the more money you make, the more you can take more aggressive expenses, right? But there's also the same time is this a necessary expense for the business owner? And that comes down to Code Section 162A. Is if the expense is not necessary for the business owner, the IRS will disallow it depending on the IRS auditor you get. And I say that because every single audit is different. There is an actual human on the other side, and depending on how that human feels that day and what's going on in that person's life,
case by case,
can determine how aggressive the IRS auditor wants to be. I've had taxpayers who didn't document things very well, who have gotten audited by IRS auditors who just were lazy and just didn't have the time, and they got off with a lot of expenses that they had no documentation for, no receipts for, just because the IRS auditor felt like it would be too much of their time to try to really dive into all this and figure it out. But I've had IRS auditors who have audited clients that were so persistent on getting my clients for very specific deductions that they were going the extra mile asking for extra bank statements, extra receipts, time logs, and it can be, a case-by-case situation. So that's why it's best practices, and most CPAs will tell you, don't be too aggressive. Don't take these types of deductions. It's better to play it safe because a lot of CPAs have dealt with audits with their clients, and they understand just how aggressive an auditor can be.
Yeah. Interesting. Have you ever had a situation where the auditor didn't agree to a first class seat on the flight?
Not on flights. I feel like travel is one of the things that auditors will more or less not try to argue too much with business owners on, because most business owners are taking flights or staying in hotels with a true business purpose. There's sometimes where we'll see, business owner taking a vacation that they're trying to justify as a business trip. But most business owners who are writing off travel are truly traveling for business reasons, and the IRS understands that that's a big deduction that most business owners are taking on a yearly basis in combination with the vehicle deduction. They like to go for more selected things like the home office deduction. There's a lot of taxpayers who will abuse the home office deduction and say that 60% of their home is in business use and write off 60% of their rent or 60% of their mortgage costs. That's when it can become aggressive.
Flag, right?
And that can become a red flag, especially since the IRS has their own document for home office and they created parameters on what they like to audit. So if they see that a home office deduction comes through their system in excess of a certain amount, they may move that tax return over in their system to be reviewed by an actual human versus just the computer.
So what's the safe write-off, office write-off? Is like
most offices are about 10 to 12% of the total space, maybe 20% on a
minus 13.
Yeah, maybe
13%.
20% depending on the house that you're in. The most aggressive I've seen was about 30%. I get clients all the time that come to me saying, I want to write off half of it, I'm using half of it for business.
I'm filming in my kitchen.
But it's too hard for them to justify that this space is truly exclusively and only used for business. Like, dude, you're eating dinner there, then you're turning around and filming a YouTube video there. It's clearly not, business.
Yeah. What are the other red flags?
I would say a big red flag is taking miscellaneous expenses. Although it's a category on the tax return, the IRS intentionally put that category on the tax return to audit more small-based business owners. Most business owners who are S corporation owners or LLC owners are making more money than a sole proprietorship. So they're not taking a whole lot of miscellaneous expenses because they're having their tax returns filed by a CPA and they may have a bookkeeper that's doing their bookkeeping. But for most people who are filing their own returns, they're confused around which categories to put write-offs. Is this equipment? Is this tools? Let's just put it in miscellaneous. And if you have exorbitant miscellaneous expenses, let's just determine right now, what is a miscellaneous expense? I don't know, and I know maybe you don't know either, and neither does the IRS. So the IRS loves auditing clients and taxpayers who have miscellaneous expenses because they'll come to find out that a lot of these expenses that got shoved into this category actually truly aren't business write-offs.
Okay.
Another bathroom, guest bathroom, production bathroom. Yes, we write this off as well. You're allowed to have a bathroom for your office, and you can write that off in case you guys didn't know that.
Nice.
Make sure your tax professional tells you that.
Okay, so you know everything about taxes. How do you pay taxes?
This year
you're able to do zero every year.
This year will be a year in which I pay taxes, but for how much money that I'm making, to say that I'm paying less than 5% in taxes is pretty. I'm pretty proud of that. Last year I was able to get my taxes to zero. This year I thought I bought enough real estate to get my taxes to zero. I found out I didn't buy enough real estate. And it's typically because it's hard for me to predict my income when a majority of my clients come right at the end of the year. So October, November, even in the first few weeks of December, I'm getting so many business owners that profited this year that are like, Karlton, help me, I'm gonna pay the IRS all this money. I wanna figure out what strategies I can do. So a lot of my team is working around the clock right now, supporting me and making sure that all the tax plans are being delivered, and that also fluctuates my income, and it's all at the end of the year, right? So,
but it's a good problem to have.
Great problem, but it's also like, dude, you have to strategically map out what you're gonna do right at the end of the year, or else as soon as the money comes in, it's just gonna go right back out the door to Uncle Sam, right? So that's why me and my wife are always aggressive in the beginning, first half of the year in buying real estate. And we are anticipating making a lot of our revenue towards the end of the year. So that way the real estate we bought at the beginning of the year will turn around and offset all the income we're making at the end of the year.
So you're buying another property in like a couple months?
I'm actually in escrow right now, and I'm hoping that it closes in Lubbock, Texas on those duplexes that I shared with you. So one of those duplexes hasn't closed escrow, and we're hoping it's gonna close next week right after Christmas on the 26th.
And all of your duplexes also rent payments cover mortgage, right?
Yeah, absolutely. All of my duplexes cash flow. All of them have given me great cost segregation studies. And one of the things about Lubbock, where I buy my properties, is these buildings that I'm buying are 95% building value to 5% land value. So when I perform a cost segregation study, I'm sometimes getting more than 30% because I have so much building value. Whereas opposed to buying a property here in California where the land is like, I don't know, 30% or 70% and the building value is 30%,
Yeah.
doing a cost segregation study on a property here in California isn't going to reap the same benefits as opposed to a property that's a little bit more cheaper and where the land is a little bit cheaper, like Texas.
Yeah. Well, thank you so much. That was super inspiring, and I think I'm inspired to buy the second property in Florida. So thank you for that.
I think I'm inspired to buy my next property in Hawaii, and thank you for having me on.
Yeah, thank you so much. I think it was super useful, guys. Please comment down below what was the most useful tax strategy for you. And thank you so much for sharing this video with other entrepreneurs in the US. Bye.